Welcome to Talk Tickers, where we break down the earnings calls that are moving the markets. And today, we are digging deep into Whirlpool's Q3 results. All right, first things first. Look at that pre-market pop. Whirlpool shares jumped over 5% on October 28th, right after their earnings dropped. So you gotta ask, what did the market see that it liked so much? Let's get into what really drove that reaction. Okay, let's start with the headline numbers. This is what really got everyone's attention. The results blew past what analysts were expecting, and that's why you're hearing this phrase all over the street, a better than feared quarter. So starting with the bottom line, Whirlpool came in with ongoing earnings per share of $2.09. And here's where it gets really interesting. It's not just that they beat, it's how much they beat by. That 209 number, it just completely crushed the consensus estimate of $1.39. We're talking a 70-cent beat here. That is a huge outperformance. And it wasn't just on earnings. The top line, the revenue, also came in looking pretty strong. They posted $4.03 billion for the quarter. Yeah, that number topped expectations by a cool $100 million. And it even showed 1% growth compared to last year. Now, 1% might not sound like a lot, but in this kind of environment, hey, any growth is good growth. Okay, so this is where the story gets a little tricky. You see, the big numbers, the revenue and the earnings, looked fantastic and caused that stock pop. The moment you look under the hood, some questions pop up. Their ongoing EBIT margin, it fell 140 basis points. That's a 1.4% drop in profitability. And even more telling, look at the free cash flow. They burned through over $900 million. I mean, way more cash went out the door than came in. That's a big deal. So let's dig into that complexity, right? We're going to peel back the layers here because the real story is definitely not just in those headline numbers. So where did that surprise revenue beat come from? Well, it was really a tale of two businesses. First, you've got their bread and butter, the big appliances in North America, chugging along with almost 3% growth. Solid. But the real star of the show, their global small appliance business. It just surged. We're talking up over 10%. That's a huge number. So how'd they pull that off? Well, according to management, it all comes down to product innovation. The CEO was really clear on the earnings call, pointing to market share gains and getting more space on retail floors. And he said it's all thanks to what he's calling a record year of new product launches. And this right here, this is the core conflict, the real push and pull of the quarter. On one side, you've got this awesome story of revenue growth, new products flying off the shelves, grabbing market share. But on the other side, that success is getting eaten away by shrinking profit margins and that really ugly cash burn. So, it all begs the question, right? What's the game plan? How is management going to navigate these choppy waters? Let's take a look at their strategy. Their strategy is kind of like a two-pronged attack. On offense, they're going all in on product-led growth. Think big, splashy launches for brands like KitchenAid. And then on defense, they're getting super aggressive on costs. They're trying to cut about $200 million in structural spending. At the same time, they're beefing up their U.S. factories and just trying to deal with this messy, tariff-distorted competitive landscape. Now, this is maybe the most important part. They held their full-year guidance steady. They didn't blink. For the market, that is a huge signal of confidence by saying, hey, we still think we're going to hit our targets for sales, for earnings, and get this, for a positive $200 million in free cash flow for the year, management is basically telling investors that Q3 cash burn, don't worry, it was a blip. We're going to turn it all around in Q4. So if you're an investor, this is your checklist. These are the 4 things you've got to watch. Number 1, do all the crazy promotions in the market start to calm down? 2, can they get their profit margins back on track when some of these one-time costs are gone? 3, will those investments in their Ohio factories actually start to pay off? And the big one, the absolute nail-biter, can they really deliver on that full-year free cash flow promised after that disastrous Q3? All right, that brings us to the moment of truth, the final verdict. Where does the stock go from here? Before I give you our official rating, let's lay out the bull case versus the bear case. So we've got the good, that better than feared headline beat, and we've got the bad, the ugly pressure on profits and cash. So, what's the trade? If you're on Team Bull, you're betting on that product momentum. You're trusting that reaffirmed guidance, and you believe in their cost-cutting plan. But if you're on Team Bear, well, you just can't get past that brutal margin squeeze, that giant Q3 cash burn, and all the uncertainty still swirling around the competition. So where do we land? Our official call is market perform. Look, the strong sales and the steady guidance are good signs for sure. They totally justify that pop the stock got after earnings. But for us, the good is perfectly balanced by the bad. Those huge risks to their profit margins and cash flow, they have to be resolved before we can get any more positive on the stock.
This is not financial advice.